One. Well, hi, everybody. Thank you for joining us on another episode of Real Talk. I am Evan Swanson with Guild Mortgage, and very excited today because I'm introducing my audience to someone that, my audience to someone that probably had never heard of before, but inside the Guild ecosystem, this guy is a really big deal. And that is David Battany, who's vice president of our capital markets, which means David oversees all sorts of investor relationships, hedging, and all sorts of things that are way above my pay grade. So, David Battany, welcome to the Real Talk episode. Thank you so much for joining me.
Thank you, Evan. Glad to be here today.
And when David Battany is on the agenda for any guild event, that event is well attended. And so, again, we have ourselves a treat today to have David be a part of this. David, before we kind of get into your career in mortgage, tell us, where did you grow up, and then how did you find yourself into the mortgage industry?
I grew up in Colorado. I grew up in a mountain area west of Boulder, very rural mountain area. So most of my childhood was in the mountains with trees and wildlife and nature. Went to school in Boulder, went to University of Colorado Boulder,
Awesome.
and I graduated with a degree in finance. And I thought, well, I should go get a job at a bank. So I interviewed at a bank, and they had a job in their mortgage division, and I literally did not know how to spell the word mortgage. I had just one G in it in my spelling, but that's how I started. I started off in capital markets as a bond trader and a mortgage hedger, and but that started my career in mortgage. I then ended up at Fannie Mae, worked there for 22 years, and have been in the industry ever since. I went from Fannie Mae to PennyMac, and then PennyMac to Guild. But I've been my entire career in the mortgage business, either in production, hedging, secondary marketing, or credit risk.
It's funny because I think, and my story is true of this as well, is that I went to college, majored in finance and economics, and sort of saw myself probably more along the lines of investment or wealth management, and found myself into mortgage. Not a lot of people go to college and think about a career in the mortgage industry. Many of us find ourselves here, but it sounds like you went kind of 0 to 60. You were automatically sort of in the capital markets division, trading bonds and hedging. And for, I think, many of the audience of this, they won't necessarily understand the importance of that role in the mortgage process. But could you give a very basic explanation of what hedging means and what
Sure,
benefit that ultimately offers to a home buyer?
sure. In the world of secondary marketing, where hedgers work, the reason they call it secondary marketing is the primary market is when a loan officer talks to a borrower, makes a loan. And then once that loan is made, that loan is then sold to investors, which is considered the secondary mortgage market. So as a hedger, what we do every morning is we look at the bond markets, specifically the Fannie Mae, Freddie Mac, and Ginnie Mae bond markets, and we take those bond prices and convert those into interest rates for the rate sheet for the company every day. And then as loan officers throughout the day start to lock in rates with borrowers, we then take those rate locks and we basically sell a hedge, which is a forward trade. So if we do 10 rate locks with 10 different borrowers for a total of $5 million, I would then do a trade for $5 million to Fannie Mae, and that locks the rate in with Fannie Mae, which allows us to then lock the rate in with the borrower. And so the term hedge just means that for every rate lock we create an offsetting forward sale of a loan to Fannie Mae or an MBS to Fannie Mae or Freddie Mac or Ginnie Mae.
Right. So what that does, I mean, it used prior to these sort of financial derivatives and strategies being used in the market, a buyer would go into contract and be in escrow, and that might take 30, 40, 60 days. All the while their interest rates floating. And it wouldn't be until the very end that the bank was able to secure a locked rate for that borrower. And that's a lot of sleepless nights. And so, what hedging allows us to do as a loan officer is go to a home buyer and say, hey, listen, we can lock your rate today for the next 30, 45, 60 days. And that way, as you go through the process of doing your inspections and we're waiting for the appraisal and going through underwriting, we're not worried about rates going up or down. Is that a fair summary?
It's very fair, and I think many times it's an underappreciated benefit. I mean, the ability of a person who on the very first day of applying for a loan can lock in their rate up to the time they close, which could be 30, 40, 60 days away, or whatever it might be. That's an incredibly powerful consumer protection
Yeah.
because for all the time you spend investing into applying and getting approved for a loan and looking for properties and putting down offers on properties, if rates jump up and you can't qualify, you've just wasted a lot of your time. And
Yeah.
to protect a consumer and lock that rate is an incredibly powerful protection that many times I don't people appreciate as much as they really should.
I think we take it for granted now because it's ubiquitous, but it
Right.
is a tremendous benefit that we can offer. And I would say that's sort of some of the fundamental tasks that secondary markets perform. There's a whole list of things that you guys do. Um, but one of the things that really drew me and one of the things I really appreciate you, David, is you have found a passion to explore creative ways to bring affordability to home ownership. And I know for a loan officer here at Guild and looking at the large playbook of loan programs that we're able to offer, a lot of that is credit to you because you've worked tirelessly to bring all these options to us. Maybe can you give the background? I mean, this clearly is a passion of yours, but how did this become a passion of yours to work towards, again, creating more affordable options?
I think several parts of my life sort of came together to draw the conclusion to me in how important homeownership is to our communities. So during my career, I worked many years in Pasadena, California, which is a part of Los Angeles County. So I worked for Fannie Mae in mortgage finance and affordable housing issues during my day job. I worked as a reserve police officer in evenings and weekends. And I started as a rookie police officer, literally in the middle of the Rodney King riots. And
Wow.
Pasadena is a city that has, a lot of diversification, by economics, racial, and other historic sort of separations. 1/3 of the city is public housing projects in low income areas, 1/3 Black, 1/3 Hispanic, and 1/3 white. So I was quickly immersed in racial tensions and various issues between police and community. And one of the things that really stuck out to me at the same time I was doing this, I was also working for Habitat for Humanity, both as a volunteer builder, but then I joined Habitat's board and also worked with Rebuilding Together, which is similar to Habitat, but Rebuilding Together works on existing homes where either senior citizens or low-income homeowners are struggling to keep up the maintenance and have basic like safety issues in terms of
Hmm.
a furnace that's not working well and is at high risk of carbon monoxide poisoning or starting a fire and needs to be replaced.
Hmm.
So I'm working in the community in different ways as different volunteers with different sort of angles. And there was incredible tension between the Black community and police. And so if I was on a call in a public housing project that had very hardcore violent gangs, it was a very dangerous place to be many times. And if we showed up to a call and we were helping, literally, if a Black grandmother just got mugged and she's the victim, we're trying to assist her, we would soon be surrounded by a crowd of people that'd be very hostile and be
Mm.
threatening. And I thought, wow, how are we going to ever solve our issues as a country or as local communities with these levels of tensions,
Hmm.
misunderstanding, and just deep-seated hatred?
Yeah.
And one day I was on a call, and there was a Black man about my age, and we are talking, and he was answering a lot of questions and helped me complete a report on a crime that just happened, which was incredibly unusual. Like
Yeah.
when we responded to crimes, nobody would talk to us.
Hmm.
Nobody would describe what just happened, who the suspects were, which way they went. And it was just so hard to try to solve crimes when there's just no cooperation and there's just complete distrust.
Yep.
And so I'm talking to this person, and at the end of our conversation, when I'm all done, I said, "Can I ask you a question? Why are you even talking to me? Nobody in this neighborhood ever talks to me. Why are you talking to me?" And he pointed to the house we were standing in front of. He said, "I just bought this house. I'm the first person in my family to ever own a house, and I want to do whatever it takes to make this work. I care about the guys smoking crack around the corner, the graffiti over here, the trash over there. I want to work with you to make the neighborhood better. We still have our issues to work on, but I want to work with you to make this happen." And I
That's
thought, wow, as a homeowner, he cares, he's invested. I wonder how many other people here own home. So I wrote down his address and I went back to work Monday morning at Fannie Mae. I looked up his address in Fannie Mae's system, and sure enough, it was a Fannie Mae loan.
wow.
And the amazing part was I had just won an award for the most innovative affordable housing program of the year at Fannie Mae. And I had a little lucite plaque on my desk for this award that I had won. And it was just a very theoretical award. And
Right.
all of I looked in, that loan was one of the loans in this program that I helped to create.
Wow.
And so for me, that was sort of connecting the dots. That was the universe connecting the dots for me with a big megaphone in my ear saying, hello, there's a huge connection to affordable housing and home ownership and people being connected and involved in their communities. And I started my career in the middle of the Rodney King riots. There was many other social disruptions during my 32-year career. But if you are vested in your community, if you own property and you are growing your value as the community grows and you feel part of it, you're much less likely when some event occurs to want to burn down your community because it's part
Yeah.
of you. It's it's
Yep.
it's your involvement. And so I looked around for other owner-occupied properties with Fannie Mae loans in the neighborhood, and it was single digits and about 1 or 2%. And
Hmm.
right there, that was a big aha for me. If you have a neighborhood that's 98%, 99% rental, people don't care. And then I went back a few weeks later to my hometown of Boulder, where I grew up in the city when I was a young kid, my original neighborhood. So here's a very wealthy community, one of the most highly educated communities in the country, that is mostly a white community with almost zero racial tensions of any type. And my childhood neighborhood had all turned into rentals.
Mm.
Properties look like crap. There's weeds in the front lawn, cars parked in the front lawn. And that was another aha moment to say, well, if a very affluent community, highly educated, high income with high property values, and these properties look terrible just simply because they're mostly rentals, how would the average US city that has more racial tensions, doesn't has
Mm.
much income and wealth, has more issues, how's that not also an issue everywhere else? So
Mm.
me, the whole connecting the dots is affordable housing really helps create emotional stability as well as financial stability for families. Habitat did a lot of studies showing that the children who rent their whole lives, maybe their room is the kitchen table and they sleep underneath the table every night, and then they get their own Habitat home and they have their own bedroom. The emotional health of children who don't move all the time, they can create roots with neighbors and friends and coaches and teachers. All these things are really important parts of home ownership. And I think sometimes as an industry, we talk about the investment and the ROI and the return on your investment, but the emotional stability and how it connects the community are very powerful parts that I think we sometimes miss. But
Yeah.
anyway, that's the very long version of why I have such a passion to really help uh, address and solve issues for affordability and to really help drive higher levels of owner occupancy inside of our neighborhoods.
That's awesome. David, thank you so much for sharing that story. And honestly, the part of the reason I started this whole video podcast was because I think so many of us have stories within us that drive us professionally. And I'm always interested in sort of rooting that out. And to hear your story there is just so awesome and inspiring. Because you're right. I think, we sort of take for granted the community impact that we can have when we're able to create opportunities for people to own their homes. And what a wonderful story. Thank you for sharing that. I mean, listen, fighting for homeownership and affordability opportunities in the last decade has been a challenge. If you look at the data, home affordability is as unaffordable as it's been in a long time, and there's a variety of reasons for that. I think the two primary factors in my mind is we've seen really unprecedented home appreciation over the past decade. And at the same time, we've seen interest rates now increase or the cost of capital rise. And now you're beginning to see that in, for example, the average first-time home buyer is 38 years old, whereas a decade or two ago it was 28 years old. It's simply becoming more and more of a challenge for us to be able to offer home ownership opportunities. And anytime you have challenges like this, it stokes, creativity. And I'd say that you're at the forefront of that. Can you talk about maybe some of the strategies or some of the things that you're working on, or maybe Fannie Mae and Freddie Mac is working on to try to extend affordable homeownership options to communities who have historically not had opportunities for that?
Sure. The way we approach affordability is essentially we have a math problem in front of us. So the first part of the problem is that home prices have been rising faster than people's incomes. And the main reason for that is that we have a shortage of housing in the country.
Mm,
Depending what studies you look at and which data, it's anywhere from 2 to 8 million units short. I think most consensus is about 4 million. So what
mm,
that means is we have more households that want to live somewhere, whether it's condo or single family or detached home, whether they own or rent, we have more households than we have units of housing. And that gap is about 4 million. So it's like musical chairs. If you have more people than you have chairs, the
Mm.
value of every chair goes up.
Yep.
And that gap of 4 million, because we have that gap, that's why home prices have been rising every year faster than people's incomes. So the issue is, if you look backwards, before the 2008 crisis, as a country, we were building homes more than we needed in terms of we had an oversupply of homes and we were building more than we had households. When the crisis hit, buildings stopped. And even though mortgage and housing industries were hit really hard, the construction industry was hit even harder. Many construction firms went out of business, and the people that worked there didn't just take a time off, they literally switched careers into other directions. And so we were overbuilding up to 2008. We really shut down building when the crisis hit. And in 2009, 10, 11, 12, the existing supply was sort of slowly absorbed into the market. And in about 2012, 2013, the shortage began to occur as the population kept growing, and we were not ramping up housing construction to match that growth.
Mm.
So from 2012 to present, we've had a shortage.
Mm-hmm.
So first, the long-term problem is to address the shortage, but then in the near-term immediate problem is the affordability. If you're the average human with the average income, you cannot buy the average home for sale in your market. And so we have a math problem to solve in terms of how to help both the monthly payment be affordable as well as the down payment be
Mm-hmm.
affordable.
Mm-hmm.
So a lot of the ideas that we're working on for affordable housing are, can we bring innovation to address the monthly payment? So one of the ideas we're working on is an equity share structure. And the way this would work is if you buy a house, rather than putting down 95% LTV, an equity investor might put down 25 or 30% down payment. And what that does is that reduces your mortgage by 25 or 30%.
Mm-hmm.
So your monthly payment is that much lower. So you have a much more affordable home. And then what you can do is you make zero interest payment on this equity second you have. But
Mm-hmm.
then when you sell your home 10 years down the road or whenever you decide to sell, at that point you then pay back the investor an equity share. And the program we're looking at, it's a 1-to-1 ratio. So if they put in 30% cash, then they get 30% of future home price appreciation.
Mm-hmm.
And what this does is for most homeowners, their first 5 years are really tough.
Mm-hmm.
They put a lot of money down, they have this high monthly payment, they're just trying to make ends meet, and they're in a very thin capital position.
Mm-hmm.
Their cash reserves are thin, and their monthly ability to create new savings is very thin.
Mm-hmm.
And so that first 5 years is really critical. If a person can get through the first five without defaulting, their chance of defaulting really drops off as more time goes by because their income's going up, their
Right.
home's going up in value, they're
They have
getting
a 30-year
financially
fixed
stronger.
rate.
Fixed rate
Yep.
loan, the rate's not going up, their financial position improves. They're like in a financial wedge that gets better and better each year they go.
Yep.
So it's really those first 5 years are key to a person's success in their home. And so what's nice about this, it's almost like a time machine. You need money today when you're young in this tight period, and you can take some of your wealth from the future when you sell the house and make a nice gain in 10 years, and you can use that wealth today to get a lower monthly payment. So that equity share structure is something that we think will be very important to bring to the market, and it's important to do it the right way. There are other equity shares out there, and some of them you might get a 10% cash infusion, but then 50% of appreciation goes to the investor.
Right.
For some borrowers, that might make sense. I think for first-time home buyers who are trying to create wealth and you're trying to help them get into a home and then create wealth, I'm not sure that's the best structure for a first-time home buyer. So the programs we're looking at are a 1-to-1 ratio.
Cool.
So
And you and there's investor appetite out there. You can find capital that's willing to participate in that.
right. And the capitalists looking for this are more philanthropic capital
Got
investors
it.
who want to create a social good and help create home ownership.
Hmm.
Um, because the return on their investment may not be the most exciting investment option, but
Right.
it does have dramatic ability to help affordable housing and help people buy homes.
But it's also cool because it's sustainable, right? I mean, it's one thing to give money to charity and have that money goes to say down payment assistance, it's gone. But in this case, an investor who participates in something along these lines is putting the money in, the capital is earning a return, and it can be recycled down the road for another homeowner. So I love the
That's
fact
right.
that there's a sustainability element to that. And what I love about it, like I said, David, is it's human ingenuity, right? We have a huge problem ahead of us, and we can't fight it with the traditional methods of the ways we've always done things like tax credits and things like that. We're starting to think about, because of guys like you, thinking about creative ways to address these issues to hopefully solve some of these problems. So thank you for all your efforts in that. It's amazing. So a few other things I want to talk about. I've heard you speak many times. I get your emails every day. And one of the things that I love is how you talk about the power of a 30-year fixed rate mortgage. And it is really truly a unique thing. There's not a lot of countries in around the world that offer a 30-year fixed guarantee. And to your point, for those of you who ever talked to a grandparent or aunt or uncle who talked about them buying their home 20 years ago and has a mortgage payment that's insanely low, for the first 5 years, it didn't seem insanely low, but over time, their home value and their incomes increased. And the beauty of that 30-year fixed rate mortgage principal interest payment is it's a flat line. And so as a percentage of household income, it tends to decrease over time and become more and more affordable, even if it feels less affordable at the beginning. But I love the way that so I'm going to let you do it, but explain to the audience just how powerful and why a 30-year fixed rate mortgage is such an incredible tool for homeowners.
Thank you. I do think it is one of the most underappreciated structures we have today. And to your earlier point, nowhere else in the world can you buy a house and lock your rate in for 30 years and then have the right to prepay at any point in time. So, back to our earlier discussion about how those first 5 years are so important, pretty much any home buyer ever in time, you talk to your parents or grandparents or great grandparents, everybody in those first few years thought, oh my gosh, this is such a expensive payment. There's no way I can make this work. And it is very daunting in those first few years. But the beauty of it is that payment won't go up. And so even it is tough in the first few years, as you go forward, even just through basic cost of living increases, hopefully your income goes up. Just through inflation, hopefully your income goes up, as well as if you increase your skills or your value as an employee or as whatever you do for your occupation. So as time goes on, your income goes up, your payment is fixed, and that's when you start growing and creating your wealth. And there's a huge correlation to home ownership and wealth creation, and this is one of the reasons. If you are a renter and that rent payment seems crazy high, and you think you can barely get by, and then next year your income's up a little bit, well, if your rent goes up as well, you may be in a tight position forever. But with home ownership, hopefully you're in a tight position in the first few years and you start getting breathing room as every year goes by and you're in a stronger and stronger position. So it is an incredibly powerful financial tool for consumers. And you literally can lock in your rate for the rest of your life, or at least the rest of that life of that mortgage, which is incredibly powerful. The other thing I would say about it is the fact that you can lock in your rate, but then if rates do go lower, you can refinance to a lower rate at any time without any penalty or any waiting period.
Mm-hmm.
So if you put those two together, so let's say you look at a house today and let's say the rate quote is 7%, and you're not in love with a 7% rate. You have friends and family who bought houses at fives or fours and you wish you had that rate. Rather than thinking you're going to have a 7% forever, I would think about it is the maximum you'll pay the rest of your life is 7%.
That's
It could
worst
be
case.
much lower. Yeah.
Yeah.
So even though you don't love a 7% rate, think of it as you just capped the maximum you'll ever pay the rest of your life at 7%. That's your cap, and you can definitely go lower. Sometimes I describe this as like a ratchet wrench that only turns in one direction.
Mm-hmm.
You've set your maximum point at 7, and then every time rates go lower for any reason, if you own that property for 5, 10 years, maybe forever, the rest of your life, as we have recessions, any reasons the economy goes up and down, rates go up and down, whenever it goes lower, check with your loan officer and just see, hey, is it gone low enough where it makes sense to refinance? And you can do refinances for free pretty much anywhere in the world these days, at least in the United States. So it's just really your time to put in, to apply for the loan and supply the documents that you need for the refinance. So it is an incredibly powerful tool to protect yourself. And at the same time, if rates do go lower, you can get the lower rate. There
Yep.
is no other financial instrument you can do anywhere to invest money in the stock markets or the bond markets where you can invest something and basically have a heads you win, tails you win bet. If rates go up, you're protected. If they go lower, you can get the lower rate.
Homeowners are actually have more power in that regard than the U.S. federal government, right? Treasuries are not prepaid, right? If an investor buys a treasury, a 10-year note, they're guaranteed to receive that interest and payment over 10 years. But if an investor buys a mortgage, that homeowner can say, hey, listen, sorry, bad deal for me. I'm going to refinance and pay your loan off and go into a lower interest rate. So it is really, truly remarkable what a gift and the structure is. It really does favor homeowners in this regard. So speaking of interest rates, David, there's a lot of misconception out there about how interest rates are determined. And you have such a unique perspective on this because you have played in the secondary sandbox for so long. It's funny. I think, if I think back to before I got in the mortgage industry, and I thought about, well, gosh, I wonder how mortgage rates are determined. I literally probably would have thought of like, a group of men in pinstripe suits smoking cigars in a boardroom, sitting around every morning figuring out what they should charge in interest. And then if you listen to the mass media, I think you would believe that the federal funds rate, the rate the Federal Reserve controls mortgage rates. But the reality is none of those things are true. I mean, what are some of the misconceptions that you see about how the U.S. public in general views how mortgage rates are determined, and then maybe share a little bit of commentary or color on how they're actually determined?
Sure. There are a lot of misconceptions, and one is the one you just stated, that the Fed controls rates, and their decision to cut or raise rates, which is maybe a political decision, is the reason rates go up and down. And so that's completely incorrect. So mortgage rates today are based on mortgage-backed security bonds. These are sometimes called MBS, for mortgage-backed security.
Mm-hmm.
These are issued by Fannie Mae, Freddie Mac, or Ginnie Mae.
Mm-hmm.
So almost every mortgage today in the United States is based on this MBS market. So
Mm-hmm.
MBS are basically bonds. If you were to buy an MBS today as an investor, you own a bond that's guaranteed by the US government, and you receive payments and interest on a bond that could go up to 30 years. So it's a long-term bond. And so today, when issued, they're competing with 10-year treasury bonds and other long-term safe government bonds.
Mm-hmm.
And so every day, different bond investors worldwide look at treasury bonds, look at MBS bonds, and they decide based on where they think the world is going and where inflation is going, whatever else they view in terms of the markets, they make the decisions to buy these bonds. And so every day, bond prices go up and down based on world events. And it's that price of a bond every day that determines the interest rate. So in contrast, the Federal Reserve, they control the Fed funds rate. The Fed funds rate is a rate for one-day loans that one bank makes to another bank. If you're a bank, at the end of every business day, you have to have a certain amount of cash on hand. You have a target amount you have to have for cash reserves. If you have a shortage of reserves, you can borrow the amount of money you need to have overnight to meet your target. So if your bank at the end of the day is short of reserves, you'll go out and borrow money overnight. You might literally borrow it at 4 p.m. and you pay it back at 9 o'clock the next morning. It's literally a one-day loan between one bank to another. And if you have a bank, you have excess reserves, you can lend it. If you're short in reserves, you borrow it. So the Fed controls that rate for these one-day loans. So as that rate goes up and down, that impacts a bank's short-term cost of funds, because some banks can use this market to borrow money every single day, and they can then take that money and invest it into car loans or commercial loans or residential loans or whatever they want to do to invest that. So the Fed controls the bank's short-term cost of funds. So it does give them a way to kind of impact the economy and impact lending rates. But really, what the Fed controls are short-term rates, which might affect a HELOC rate on the prime index. But if the Fed makes a rate cut or raises rates, it doesn't always impact long-term rates like 10-year treasuries or 30-year mortgages. So the takeaway is the media has a lot of attention on the Fed funds rate, and that it does help when rates go down, but they only control the one-day rate and short-term rates, and mortgages are driven by the long-term part of the rate market, which is many days completely separate and independent of the short-term market.
Love it. Thank you. And I wish it was a federal law that the mass media would have to file that disclaimer anytime they're reporting the federal funds rate to say, hey, this is what the rate is for banks to lend money on overnight loans to meet deposit requirements, right? Because it's so funny. It's actually a very obscure function in our economy that most people don't even think about. Yet the mass media spends most of their time reporting on interest rates focused on this federal funds rate. When to your point, there is a much tighter correlation, especially day in and day out, with the 10-year treasury note. In fact, I read a paper, I think it was issued last November or December by a Fannie Mae economist who did a really nice job of sort of highlighting that relationship over time and basically defined a normal interest rate as being between the yield on the US 10-year Treasury note, which you go back and look at 150 years of history, is around 4.5%. And then there's spreads that get built on top of the 10-year Treasury to represent what homeowners borrow at. And part of that is the cost of origination of a mortgage. Part of it is what we talked about earlier, is that there's greater risk to a mortgage investor than there is a treasury investor, A, because households are not as financially strong as the US government, and B, that homeowner can cash that loan in as soon as rates drop, and that investor is less left getting their money back in a lower interest rate environment. So for those
Right.
reasons, the spread between a US 10-year Treasury note and mortgage rates are higher, and that spread can vary over time, but historically it's been around 1.5 to 2.5%. And so I'm just curious, David, based on your understanding of the current market conditions, their spreads have widened in more recent years as yields have gone up, and there's reasons for that. There's some optimism and hope in the mortgage industry that we might see those spreads tighten a little bit, which would help mortgage rates go down. Anything on the horizon that you see there, or just generally any forecast that you see regarding interest rates moving forward?
Yes, the spread you described is a really important part of the equation. And we talked about, if you're the home buyer, you have a heads you win, tails you win bet. If you are the investor in the MBS, you're on the other side of the heads you win, tails you win bet. Because
Mm-hmm.
if you invest a bunch of money and you buy a bond at 6% today, and rates drop down to 5, you're excited because you have a high 6% and the current market's 5. You have an above market value. It's really valuable. The problem is those are the borrowers then refi, and then your MBS disappears.
Mm-hmm.
And the reverse happens. If you buy a bond at 5% and rates jump up to 9%, you hope your money's pays down at the 5% bond. You can reinvest that money at the new 9% rate. Well, those borrowers with the below market rate have huge incentive not to refi and not to
And
sell their
there's
house and keep
trillions
it.
and trillions of mortgages out there right now that are in that position.
Yeah. So that's why there's always a spread, and that spread is important because every day when we wake up, we can look to see, okay, what's the yield on a 10-year Treasury today? It's usually around 4.5, and what's the yield on a mortgage, which is usually about 2.5 points or more above, and see, which way are these moving, and which means do rates get lower, or higher on today's rate sheet. So it's an important part to look at. Um, the spreads have been narrowing, which is a good thing, meaning mortgage rates are coming down lower compared to treasuries, and there's good possibility that can continue more through this year. The biggest driver of where interest rates go, a big part of it is where inflation goes. And we should think of inflation from a bond market view as like a rising tide. As it goes up and down, all interest rates go up and down accordingly. And the reason is very simple. That if you're an investor and you invest money, you want to earn a return over the next 10 years above the rate of inflation. So if inflation is going to be at 2% and you want to earn 3% above it, you need to buy a bond that pays you 5. Your money is growing at a 5% rate, it's getting eaten rate, your net percent gain. So as inflation goes up, and most importantly for mortgages, it's not where inflation is today as much as where inflation is going to be next year or in 2 years. Investors who buy a bond today that's a 10 or 20-year bond, they try to predict where inflation will be for the next 10 to 20 years. Today's inflation rate matters a little bit, but it's really where they think it's going to be. So they try to look at long-term factors in the economy that could be driving inflation higher or lower and try to predict inflation levels and then make the decision based on those predictions what price they should pay to buy a bond today. So long-term inflation is a big part of it. The other part I would say is that probably the second most important thing to look at in today's market is the government deficit. When the
Yeah, let's
US
talk about
spends
that.
more money than we have in tax revenues, we have to finance that deficit by issuing treasury bonds. So the more treasury bonds we issue, we start to saturate the market with more and more bonds, and that naturally drives up interest rates. So if we can shrink the deficit, then that helps lower interest rates for long-term debt, especially for mortgage rates. And so if you want to shrink the deficit, you have to either have more tax revenue or less government spending. So as we were approaching the elections, the markets came to the conclusion that whether Harris or Trump would win, the markets thought either candidate by the end of their term would grow the deficit. That if Harris had won, she would spend more but tax more, but still have a growing deficit. And that if Trump were to win, he would tax less and spend less, but he would still have a net deficit. So that's why interest rates before the election started rising, because the markets are about a 50-50 coin flip who would win, but they thought whoever wins, we're going to likely have a growing deficit. So
Hmm.
a key question as far as which way rates will go is, can the deficit shrink? So Trump's clearly trying to cut costs, but he wants to hold tax rates low.
Hmm.
So it's the delta between how much revenue comes in from taxes and how much spending is reduced if we do get a net deficit reduction, yes or no. But if
Right.
we do, that would lower rates. If the deficit grows, that would push interest rates higher.
Yeah, great. So, and that's, when we're talking to customers on our end and, saying, okay, great, now that you're in contract, we can lock in a rate for you and provide that security we talked about earlier. We're really trying to look ahead and say, well, mortgage rates could move higher, they could move lower, they could stay the same. And what you just described is basically that will happen based on the market's understanding and forecast of what inflation, the budget deficit, and maybe even the labor market. And labor market is really just inflation when we're talking about that. And there's so many factors that play into that. It's really, really difficult to know. And so one of the other things you've done before in some of your commentary is sort of encourage customers to lock. Explain that philosophy.
I would say the markets today are at a crossroads in terms of which direction inflation is going to go and which direction interest rates will go, because you cannot have inflation go up and not have interest rates also go up. It's impossible. In my opinion, it's impossible. They'll both go in the same direction. So today, if you talk to the best portfolio investor in the world, the smartest Wall Street investors, nobody knows which way. People might have opinions, but no one is
Mhm.
confident which ways things can go, especially with tariffs and how those might be good or bad for the economy, good or bad for inflation. So, what I would say today is we are at a crossroads where you can make strong arguments both directions where inflation goes higher or lower. And as we go forward, if inflation does go higher, interest rates will go higher without question. So if you're at a 50-50 crossroads, to me, this is the perfect time to buy a house and buy it with a 30-year fixed rate loan, because that heads you win, tails you win bet. If
Mhm.
there's a 50% chance, if you don't like rates at 7 today, well, what if they're at 8 or 9% in the next 1 or 2 years? That 7% rate will look beautifully low. If rates go down to 6 or 5%, you refinance down. If they go up to 8 or 9, you thank your lucky stars that your loan officer and your realtor told you to lock today and to buy today.
Yep.
So when you have incredible uncertainty, if you were trying to invest bonds, if you work for the world's best endowment and you have $100 million to invest, do you go stocks or bonds? Which way do you go? You're making bets and you may win or you may lose. If you buy the house and your interest rate bet, you cannot lose. Heads
Yep.
you win, tails you win on the bet. So
Yep.
buy today. In my advice, the markets are uncertain and they're going to be very volatile. Every day we're going to wake up with new news stories about some new change, new thing happening. Could be good, could be bad. We're going to see rate sheets getting better and worse every day in a very volatile time, in my opinion, for several months. Could be 6 months or plus or more. My best advice is when you have lots of volatility, uncertainty in the markets, lock your loan in early. Don't float the market, because if you float, you're taking a 50-50 chance of getting a worse price that may be worse forever or a long time at least. Lock today, lock in your rate, buy the house with a 30-year fixed rate, and just think of it, that's your cap. That's the max you're going to pay. And if rates go lower in 6 months, great. If they go lower in 6 years, great. Whenever they go lower, you refinance every time. And every time they go lower, you get a lower rate, a lower monthly payment, and you're now creating more wealth, because every time you refinance, you're putting more money in your pocket, and your cash financial equity in the property and your monthly cash flows are both getting stronger.
Love that. The other thing I'll just add to that, David, that I often talked about with my clients is rationally, you're absolutely right. It's 50-50. We don't know. So let's take the certainty and move forward, knowing that you can move lower. The other side of that is what behavioral economics has shown in the last 10, 20 years is that the way our human mind is wired, we value marginal losses greater than we do a marginal gain. In other words, if I present an interest rate of 7% to a customer today and they decide not to lock it, and then I call them on Monday and say, hey, great news. We didn't lock on Friday, but we can lock today on Monday and rates are 1/4% better. They'd say, okay, that's pretty cool. I like that. But if I called them on Monday and said, hey, yeah, shoot, we really should have locked on Friday. Rates are now 7.25. They'd go, oh no, I should have locked. And they'd be much more upset on a marginal basis than they would be excited for a lower rate. And so just the way our minds work, just lock it, take the certainty, and to your point, long term, knowing that that's may not be your rate forever. We're just trying to get through this initial period. There will likely, certainly cannot guarantee, there will likely be periods of low interest rate environments in the future. We'll track that for you and move on. So well, David, that about wraps up our time. Listen, I just want to say thank you for taking the time to join me on this. You're such an intelligent guy, and we are grateful here at Guild to have you as the head of our capital markets. I appreciate your commentary. More than that, I appreciate you sharing your purpose and what drives you each day. And thank you for giving us the guy that you are here at Guild Mortgage, and thank you for joining us.
It's been a privilege. Thank you, Evan. Appreciate your time today. Thank you.
All right. Well, with that, keep watching the Real Talk episodes here on this YouTube channel, and thank you so much for watching.